Hey, I wanted to welcome everybody to our Wealth and Wellness webinar. This time, Claudia and I picked a very ambitious topic, which is the One Big Beautiful Bill Act, and we are not going to be saying that multiple times. So, Claudia and I are excited about this. We do these webinars quarterly for our clients, for the team, and just for the general public. And so, this was obviously a very timely one that we wanted to do. So there's a lot of different webinars that we have available. So we encourage you to visit our library at bfgfa.com, where you can find more of just podcasts and articles and other webinars. So just for those of you who have never attended one of these webinars before, a little bit of background about myself and Claudia. I am the president of BFG Financial Advisors. I am also one of the lead advisors here in the office. So we talk with a lot of clients about some of these strategies. And Claudia is another lead advisor, certified financial planner, and she's also the chair of our investment committee. So Claudia is going to be talking, kind of some of the investment strategies potentially surrounding some of the changes in the bill. And then I'll be talking, some planning opportunities also. A couple of disclaimers. We are not accountants. So our focus today is not going to be on tax preparation or filing details. Instead, we do want to concentrate on the planning opportunities that come out of this new legislation, how these changes might impact your long-term strategy, and what steps you can consider, maybe to make the most of these changes. Claudia, I don't know if you want to add anything to that before we begin.
No, yeah, absolutely. It's nice to be here, everybody, again. And just as Lena said, this is a big topic. There's a lot of information that we're going to cover, and I think do our best to put our financial planner hats on and kind of make this relevant from that perspective. So I'll do my best to bring up opportunities where we see them, but bear with us as we go through the One Big Beautiful Bill Act.
All right, so let's just jump right into it. So what is staying the same? And also, actually, I should mention, if you have questions along the way, please feel free to ask them through the webinar. Some of them we can answer during the presentation, and others we can wait to answer them at the end. So Hannah is in the background going through and collecting all those questions. So if we can get to the next slide, we can talk about what is actually staying the same. And I think this is probably the easiest slide because it's the shortest of things that remained unchanged. The continuation of the tax brackets and standard deductions, the individual income tax structure established under the Tax Cuts and Jobs Act is now made permanent for this year and beyond 2025. This was a big item because as planners, we wait to see if the tax rates are going to change based upon what we want to start planning for at the end of the year or getting into next year, and if we have to take income in different years. So the tax brackets are staying the same. Ordinary income and capital gains tax rates, again, those have stayed the same as well. So no big changes here. It is important to understand, though, that this is just at the federal level. Many people don't know that states also have capital gains rates. So in fact, there's actually only 8 states that do not have a capital gains rate. We had a client situation recently where the wife was needing to sell some stock for a personal investment, but being in the state of Maryland, she would have had a significant capital gain event on top of her existing income. So in discussions with the CPA, we talked about married filing separately versus married filing jointly to minimize those gains. So if capital gains rates did jump under this new bill, we would have obviously been having different conversations. So even though capital gains rates have remained the same, it's still important to understand if anything changed within your state capital gains. And then the suspension of miscellaneous itemized deductions, that's continuing. So again, the Tax Cuts and Jobs Act, suspension of miscellaneous itemized deductions such as unreimbursed employee expenses, those are going to remain into effect. So there's no changes there. And then the child tax credit was made permanent at about $2,200. And then lastly, Qualified business income deduction. For those of you that aren't familiar with this is a tax deduction that allows eligible owners of pass-through businesses, such as sole proprietorships, partnerships, S corps, and also some trusts and estates, to deduct up to about 20% of their qualified business income from taxable income. So for those that qualify, it can significantly reduce their taxable income and just overall lower their tax liability. So this is actually remaining intact. So bottom line, there's no surprises on these. This is traditionally the foundation of your yearly tax planning when you think about your deductions or your tax brackets, capital gains. But before we, move on to discuss what is changing, keep in mind that a lot of these changes that Claudia and I are going to go through, some of them are temporary. They have different time periods to qualify. The bulk of them have to be qualified based on your income. So that's why it's extremely important to plan around these deductions, whether you're talking with your accountant, your tax advisor, your financial advisor. It is important to have these conversations throughout the year, because if you can leverage these strategies to get your income lower, it could possibly open up the door to get some more deductions and credits also.
All right, so I'll kind of touch on the first one here. And one of the most significant provisions of the Tax Cuts and Jobs Act, which is, what everybody was questioning if that was going to allow to sunset, was from an estate planning perspective. So if we go back to 2018, the gift tax exemption at that time was 5.6 million. So at that time, it was doubled to 11.2 million per person. And it's been growing through the rate of inflation since then. So fast forward to today, the exemption is 13.99 million per person in 2025, double that for couples. So significant opportunity there to pass assets for high net worth families without paying the estate tax, which is the highest tax rate at 40%. The new legislation increases the gift and estate tax exclusion slightly to $15 million per person. This will take place in 2026. But the other important thing here is that it continues to be inflation adjusted in future years. So for 2026, this is $30 million that can be passed without incurring taxes for a couple. Although a small increase from 2025, this is going to be the largest exemption ever. And we should also remember that if the Tax Cuts and Jobs Act had been allowed to sunset, this would have been decreased by 50% at the end of 2025. So while a small year-over-year increase, what we were all talking about with clients and kind of potentially planning for was what happens if that would have been cut in half. So this allows for people to continue to pass taxes through their estate. For those that potentially did some planning ahead of the exemption coming down, families who potentially made large gifts, for example, there may be some opportunity to see if the trusts allow for any changes to be made for the new legislative environment. Keeping in mind, however, that this could change again. There is no guarantee that this will remain the same, but at least for the next through 2029, we can kind of expect things to continue to grow at the rate of inflation. So good news for those that were hoping to do some planning. Those opportunities still exist. All right. The next one is the expansion of the SALT deduction. So SALT stands for state and local taxes. I think this was one of the most discussed topics going into the negotiations for the bill. Under the Tax Cuts and Jobs Act, TCJA, I'm not going to be able to say it that much, the most that anybody could deduct in SALT from federal taxes was capped at $10,000. So under the new legislation, this has been temporarily increased starting in 2025 to 40,000. It'll increase again at 1% per year through 2029, with the cap reverting back to 10,000 in 2030. So this is one of those temporary changes that's been passed through the bill. And for those that are in higher in states with higher income taxes, they'll be allowed to offset some of that income for the next few years. Those there is a phase out. So another kind of nuance. I think a lot of these legislations have nuances. There is a phase out for the deduction. So for clients that are close to the phase out, which begins at 500,000 for single and joint filers, they'll want to start talking to their CPA and their financial planner. Because once you hit that phase out range of 500,000, the deduction is pretty quickly reduced. It gets reduced by 30 cents for every dollar beyond that threshold. Once you get to 600,000, you're back at the $10,000 floor. So if there's opportunity to, potentially avoid additional income in December and push it into the next year, for example, to avoid hitting that threshold, that those are conversations that you should start having with your financial planners. Other ways that you could maybe look to avoid that phase out raise is to look at above the line deductions. If those are available to you, you have to talk to your CPA about those. Make sure you're contributing to your 401ks. Make sure you're maximizing your HSA contributions. If you're self-employed, you can write off half of a self-employment tax. These are all potential deductions that could get you below that line. You also have the option under this new legislation to bunch deductions together into a single year to potentially avoid the phase out for 1 year and then use the standard 10,000 deduction in other years. So good news here is that the cap has been raised to $40,000, and for most taxpayers, I think they'll find that they are paying less in taxes because of this. Bad news is it's complicated. So if you are a high earner and you're close to that threshold, make sure you're having conversations with your advisors, your CPA. Lena mentioned capital gains. That's something that could inadvertently push you over. So I think 2025 really is the year to start making sure that you are closely talking to your advisors as you get close to the end of the year.
Thanks, Claudia. I think that kind of is a healthy summary to probably this whole webinar, which is it's complicated. And that's truly what it is. And a lot of what Claudia just shared, I'll be talking about during the various deductions and opportunities, because you really do have to think about if we're taking things in 2025 or 2026 because of the timing of everything and the different phase outs that have changed. So tax planning, quite honestly, is going to be pretty crucial over these next few years. And that probably means that we're just going to have to also do more webinars on these topics as well. So AMT is back, and we put kind of sort of. So for those of you that don't know about AMT, it's called Alternative Minimum Tax. It's actually a parallel tax system designed to ensure that individuals with high incomes pay a minimum amount of federal income tax. And so you traditionally see this with certain types of stock options or types of tax-free income. That's when AMT kind of comes into play. So what this bill did is it extended the higher individual exemption amounts, and they're going to be indexed for inflation. But what it also did was it actually reverted the phase-out thresholds back to the 2018 levels. So just to put this into perspective, right now, the phase-out threshold for a single filer is 626,000. It's now going to be only 500,000. For married filing jointly, it's at 1.25 million, and it's going back to $1 million. So what that means is that more people are probably going to start seeing AMT a little bit more. This starts in 2026. So the key on this one is if you're an individual who has stock options, depending on the type of stock option you have, it may be worth exercising those stock options this year versus waiting until next year. Along the lines of what Claudia talked about on the SALT area, this is a key area to where tax planning becomes more crucial, because you want to make sure if you're going to exercise those options in future years or your income is jumping above those thresholds, that we do things to try to reduce that income so that you're not getting caught by AMT. The next slide has to do with itemized deductions and some changes there. So there's a few things that are changing under the charitable, basically just charitable strategies. We saw a pickup in charitable contributions when individuals would turn 70 and a half and being able to make qualified charitable donations. We saw a pickup in utilizing donor advised funds over the past few years. And now there is some significant changes relating to some charitable contributions. So we now have a new floor starting in 2026. Basically, the first 0.5% of your AGI in charitable contributions is non-deductible. Okay, so you have to gift over 0.5% AGI to even qualify for the deduction. There's a limit allowing individuals to deduct up to 60% of your adjusted gross income in cash contributions. That's now permanent. And currently, our top tax bracket is at 37%, but for charitable contribution rules, you're now capped at 35%. So for those individuals that were in the higher tax bracket, you were getting a tax savings of about 37% off of your contributions. Well, now you're capped at 35%. So the new AGI floor plus the capping at 35% will cause additional taxes for those individuals if no other changes are being made. What's also new starting in 2026 is you can actually deduct contributions without itemizing. So taxpayers who do not itemize can claim an above the line deduction for cash donations. It's only cash donations. So it isn't any property or stock. Contributing to a donor advised fund does not qualify either. But for single individuals, you can deduct up to $1,000, and then for joint, you can deduct up to $2,000. It's important to understand these different deductions, itemized versus standard, because it has an impact to the surtax on your investment income, your Medicare premiums, possible Roth contribution strategies. So this is good for people who do not do any itemized deductions, but still want to be able to contribute and get a tax benefit from that. So this is a new one that we're seeing. The other new deductions that we have is, and actually, I apologize, I did miss one on the itemized deductions, is the mortgage insurance. Mortgage insurance, that was taken away a few years ago, but it has now since it has come back. So the mortgage insurance on the home mortgage is limited up to about $750,000. That is now made permanent, and that, I'm sorry, is the home mortgage interest. There is the mortgage insurance premium that you can start deducting again in 2026. So sorry for that confusion there. So if you have questions on that, just put that in the chat. But mortgage insurance premiums will qualify for 2026. It doesn't matter when you purchased your house, but it is based on your income. So that is something that if you had been paying mortgage insurance premiums, talk to your CPA because you may be able to now start deducting it. Now to talk about some of the newer deductions that we have. There's actually quite a few. And the theme with all of these is that they're timed, there's certain time periods that we have with them, and there's certain income qualifications as well. So once again, we're going to keep saying this over and over again. It's important to have these conversations with your accountant, with your planner, to talk about how we want to lump certain deductions in one year. Do we need to spread them out? Do we have any other big events that are going to be happening in your life over these next few years, like retirement or distributions for accounts that we have to time as well? So for those individuals who are over 65, there's the expanded standard deduction for seniors. You already get, your standard deduction, but it's actually going to be going up. So that's a new one. There's an actual bonus that you get on top of your standard deduction for individuals over 65, but you have to qualify based on your income. So it's actually a $6,000 bonus deduction you get per individual, which is great. It's only through 2028, and then it expires, but you do have to qualify based on income. So if we have to qualify based on income, it's important to see how far away are you from that income from qualifying, and can we take any other deductions to maybe pull that down? Should we defer any other types of income so we can keep that AGI, adjusted gross income, at a certain level? There's also qualified overtime pay deduction. So for individuals who do work overtime, you can deduct up to $12,500 as a single. Again, this is a time period. It expires in 2028, but it does become effective this year. And you have a phase out of income as well. So if you exceed this income and have overtime, you may not be able to deduct it. There's also a qualified tip income deduction. So individuals can deduct tipped income up to $25,000. Again, it's a great new deduction. However, we have thresholds, so you have to qualify from an income perspective, and it only runs to 2028, and after then it expires. There is also the auto loan interest deduction. So this is new. It only applies to vehicles assembled in the United States, and it must be a loan. So lease payments do not qualify. Claudia and I get a lot of questions from clients. Should I purchase a car or should I lease a car? This new deduction is going to weigh into those conversations on if we're able to take the deduction, because you're phased out based on your income. So for some individuals, they're just not even going to qualify. And so that may help in answering that type of question. Again, this goes away in 2028. There's also adjustments to the child tax credit. It's $2,200 per child. And then there's also the adoption credit up to $5,000 is now refundable. So as I had mentioned, all of these different ones have the time periods, and they also have income restrictions as well. So these all apply to the above the line deductions. And again, especially impactful for taxpayers who don't itemize and use standard deductions. These would help out a lot. Another theme with them is that for seniors, they're getting some healthy deductions, but it is important because when we're calculating how individuals are taking distributions from retirement accounts, which are taxable, and trying to minimize, Medicare premiums, because of that additional income, we want to make sure that we're taking advantage of all these different types of deductions. And again, proactive planning is important with a lot of these because these are temporary through 2028. So this could be a time period where you want to do significant Roth conversions. Maybe there's some benefits that you have to defer because of, what's going to be going on over these next few years. But again, it's a lot of opportunities and everything, especially on the charitable side, which kind of coincides to some of the things Claudia talked about with estate planning and everything as well. So I'm going to turn it over now to Claudia, who's going to cover quite a few things about some of the changes that are relevant for those of you with children.
Great, thanks, Lena. Yeah, so the new bill did have quite a few things there for those of you that have kids. I think if we go to the next slide, we can start with the Trump account, which I think is what a lot of people probably have questions about. So the Trump account was introduced in this legislation. It essentially creates an additional option for parents to save for their kids. We often have discussions with parents and grandparents, how can we save more for kids? How can we save more for grandkids? And typically the answers, we talk about 529 accounts. We talk about, savings accounts, benefits of having those joint account with parents or not. And then a lot of times we talk about UTMA accounts. UTMA accounts are accounts that are for the minor, but when they turn 18, essentially the child becomes the owner of that account. And those are really your main options. The Trump account introduces something new. This is, again, temporary, but for kids born 2025 and later, they become eligible for the Trump account. This is, as I was kind of reading through this, it's kind of like a Roth IRA account is the best way to think about it, but without that earnings requirement. So with a traditional Roth IRA account, this is something we start talking about when kids, get close to age 15, 16 and start having earned income. Once they get that first W-2, we can start contributing to that Roth IRA account. The Trump account does not have that earnings requirement. It can be funded up to $5,000 per year. This will be indexed for inflation. And it is funded on behalf of the beneficiary by parents primarily, but we'll talk about some other ways as well. Now, you cannot fund these accounts until July 2026. That is 1 year after the legislation of the bill. So while the bill has created these Trump accounts, you could, in theory, open the account, establish the account, but they can't currently be funded. So I think this is one of those areas of the bill where there's going to be more to come. We're going to have to wait on some of the specifics and the nuances. The account grows tax deferred, similar to an IRA or a Roth IRA. However, it is not tax deductible when you make the contribution. A difference here between some of the other accounts is that other entities, including the federal government, state and local government, charitable organizations, they can contribute to these accounts as well. From what we can see, contributions by any one of these entities do not count towards the limit of $5,000. So I'll talk about the pilot program in just a second, where the federal government contributes $1,000. That does not appear to count towards the annual limit of $5,000. Employers can also contribute on behalf of an employee, subject to a $2,500 annual cap to this account. This does appear to count towards the $5,000 annual cap. So again, lots of nuances, lots to pay attention to here. Contributions are not counted as income for the beneficiary. If a child is eligible for both the Trump account and a Roth IRA account, one does not affect the other's limits. They do function separately, so you could contribute to both in a single year. So this is a great option to get some early savings for kids early on in life and get them a good start. There are some restrictions in terms of the investments. So typically with a Roth IRA, you can really invest it as you would any other account. You have access to index funds, stocks, bonds, lots of flexibility. With the Trump accounts, you are limited to investments in broad U.S. index funds. So think the S&P 500. You can't have individual stocks. You can't have sector-specific funds. Specific market caps are allowed, large cap, small cap, mid cap, for example, but it has to be U.S. index funds. There are no distributions allowed until the beneficiary turns 18, with the exception of rolling this over into a 529 ABLE account once the beneficiary turns 17, assuming that they qualify due to disability. So if you have a child or a family member that does qualify for ABLE accounts, this is something that you might be interested in. Trump accounts can be rolled into other Trump accounts. Trump accounts cannot be rolled into IRAs. And if the beneficiary passes before the age of 18, the account does lose its tax deferred status. The growth on the account would be fully taxable to the designated beneficiary, or if nobody is named as a beneficiary, to the estate, not the contributions, just the growth. So an additional way for parents to get some money in there for kids, but as you can see, there are a lot of nuances. Once the child turns 18, the account starts to look pretty similar to a traditional IRA. It will have a mix of pre-tax and after-tax dollars. However, the pre-tax dollars will be the direct contributions, and anything from sources that were excluded from income or growth will be considered after tax. So there will be some basis in the account. After the child is 18, they now have to wait until age 59 and a half to make penalty-free withdrawals. They no longer have to follow the eligible investment rules. They can invest freely as they would in any other account. It's not clear if these Trump accounts can be rolled into IRAs at age 18. However, it was noted that they won't be subject to the IRA aggregation rules which means that these could be kept separate and still allow somebody to do what are called backdoor Roth IRA contributions. Typically, if you have an IRA, you are limited from making backdoor Roth IRA contributions, but these accounts will not count towards that aggregation rule. Things that we're looking at for from a planning perspective is if allowed, and the 18-year-old is in a low tax bracket, it might make sense to do a full Roth conversion at age 18, pay the taxes at the low tax bracket, and then allow this to grow tax deferred for still a good number of years. So a new interesting option. I mentioned the pilot program a little bit ago. The law does include the pilot program, which allows parents to elect $1,000 government credit into the Trump account for anybody born in 25, 26, or 27. The mechanics of the program are unclear. As a reminder, we can't fund accounts until July 26, so we're not sure if that applies to the pilot program as well, but we're expecting to get more information on that, hopefully, in the coming months here.
Claudia, I think this is going to be one of those types of planning strategies when we meet with, grandparents and they talk about ways to gift to their family members and everything. And there's so many strategies we use. This is now going to be another one that we'll be able to chat with them about to see how to leverage it. But as you said, there's still some details that are getting worked out before we can actually start using this.
That's right. Yeah, there's still a lot to know. But certainly a good way I think to have another option, but lots to learn. We'll probably have a follow-up webinar on Trump accounts.
Right.
If we can go to the next slide, I'll touch on the 529 plans. There were some changes to 529 plans. Really what it is, it's expanding the definition of what a qualified higher education expense was. Currently, you can take for K through 12 expenses up to $10,000 per year. That's increasing to $20,000 in 2026. The way that the 529s are currently used, it primarily has to be used for tuition, K through 12 tuition, if you're going to be using it for that. And then most people are familiar with the room and board and uses for college. But for going forward, it's going to add kids in public, private, and religious K through 12 education. They can take funds from the 529 plans. This includes not only tuition, but curriculum materials, textbooks, instructional materials, online education. It includes costs for tutoring provided outside the home. It has to be somebody unrelated to the student, and they have to meet specific qualifications. It does cover fees for standardized tests, AP exams, college admissions exams, dual enrollment fees for post-secondary programs. That's becoming, I think, a popular thing in high school for kids to be dual enrolled in a community college while they're finishing off high school. You'll be able to use 529 funds for that. You can use it for educational therapy costs for students with disabilities, ongoing occupational therapy, speech language therapies. So lots and lots of other uses for 529 plans within the K through 12 space. The rule applies to distributions taken after the bill was enacted. They could have been incurred at any point in time in 2025. So if you incurred one of these expenses in January of 2025, as long as you take the distribution after the law was enacted, then it will qualify as a qualified distribution. For post-secondary, for college educations, you can now use 529 funds for credentialing expenses, for tuition, books, fees, any other expenses required for enrolling in a credentialing program. So this is not necessarily going into a university, but getting some sort of credentials. Think a CPA, or in our industry, the CFP, the Certified Financial Planning Program. It covers fees for exams required to get the credentials and to maintain the credentials. It covers fees for continuing education. and any other costs associated with earning that. So that's certainly new. I know not a lot of employers cover necessarily expenses for credentialing. So now you can use 529 funds for it. There are also specific definitions of apprenticeships within the Department of Labor or other occupational licenses that qualify. So lots and lots of uses. I would say, if you have a 529 plan that maybe you thought was potentially overfunded, there are ways to potentially get those funds out, even as an adult getting additional credentials. And also I think for us, there are one of the big benefits to 529 plans is if your state allows for it, you can deduct it against your state income tax. But now that you can use 529 plans for lots of other things, I think there are more reasons to maybe fund these at a higher level, allow the growth to be tax deferred, and you have lots of reasons to kind of take that income tax free. So lots of changes to 529 plans. Again, we'll be happy to take questions or discuss those further.
Yeah, and I think a good strategy too is, there's a lot of individuals who have career changes and are going back to school to pursue a different degree, designation, et cetera. And if they have the money that they're spending on the school expense anyway, they can just put the money in that 529, as you mentioned, get the state deduction, and then pull it right back out to make that contribution.
That's right.
It is important. 529s are another one of those areas where while the expense can qualify to be tax-free at the federal level, there are some states, though, that will classify it as taxable. So when you're doing your tax planning, it is important to understand your state rules as well as the federal rules too, because they're not always the same.
That's right.
Thank you, Claudia. All right. So, kind of summing up, just some different types of planning opportunities. Claudia and I are just going to kind of share some of those things. Again, we've kind of been talking about some of these through the conversations as well. I do want to, reiterate the deductions that I talked about that have that 2025 to 2028 window. Take advantage of those. You may want to start thinking about what these next few years look like. Are you expecting any bonuses, any stock options to pay out? Is there any large distributions that may happen? And we may want to be able to try to qualify for some of these deductions. So we have to try to reduce that income in other ways. On the charitable side, you possibly want to look at accelerating large charitable gifts before that floor kicks in next year. We work with a lot of clients who utilize donor advised funds to where you can do front load giving and put a large amount into the fund, but then you're distributing it over years, but at least you'll qualify for the deduction this year. Or you may want to think about doing that in another year where you're going to have larger income and you want to try to get some of these deductions. Claudia talked about the SALT deduction as well. So I think it's important to also start looking at, your residency planning, timing of property tax payments or estimated tax payments. So as she mentioned, though, this goes away in a few years. So that would be something to try to plan ahead on. Roth conversions is always going to be a big one just because of the opportunity that it presents. And we could do a whole webinar on Roths and all the rules and strategies and timing. But if you have not looked at these strategies yet for Roth conversions or contributions, whether it's into your 401k Roth versus your 401k pre-tax or your TSP Roth versus TSP pre-tax, have those conversations because I think the more that you can generate in tax-free income in retirement is going to be huge for you. So you definitely want to start having those conversations concerning the timing of the various conversions. And then another one while talking about retirement, we didn't spend any time really talking about Secure Act 2.0 because we wanted to focus on this bill. But it is important in January, there is a change from the Secure Act 2.0 that actually becomes effective in January of 2026, which is the mandatory catch-up contributions that have to go into a Roth 401k versus pre-tax. So for clients that are maxing out their 401ks and are putting money into the catch-up and putting the catch-up contributions into their pre-tax, that now has to get moved over to the Roth 401k. So just that simple change will increase their taxable income. So now we have to start finding ways to reduce it back down again. So that is an important impact for clients for tax planning, and has to be evaluated before the end of the year to see what adjustments should be made. And then the last item I'll bring up before, Claudia kind of talks about some other strategies too. Claudia spent some time talking about the changes on the estate side. And the only thing that I would add to that is it is important, if you haven't already, review your life insurance policies. A lot of these life insurance policies were taking out with the anticipation that there was going to be a significant estate tax that they would owe, their heirs would owe. I remember when the exemption was at $675,000. So, there was a lot of life insurance planning that was that happened well over 10 years ago. So look at the insurance policies, see if it's worth keeping them, if they should be converted, or just maybe leveraged in a different way. But life insurance planning, which we did a webinar on risk management overall and how to focus on life insurance. If you haven't looked at those policies, get them out and have somebody review them with you to see if it still makes sense to hold on to them. So Claudia, what types of strategies can you think of based upon the various talking points we've had?
I'll just add, one more thing that we haven't touched on from kind of an investment opportunity perspective. And that is the qualified opportunity zones. So for those that aren't familiar with it, the back in 2018, qualified opportunity funds were created. This allowed investors to pool capital into funds that were investing in qualified opportunity zones. Qualified opportunity zones are low income geographic areas that are designated by the various state governments. And the tax benefits to invest in these was, especially for high income investors, was they could sell appreciated investment property, whether it was stocks or property, anything else, take the gains, reinvest those gains into a qualified opportunity fund, and then the gains were going to be deferred until December 31st of 2026. So coming up at the end of next year, or at the point that the fund was sold or exchanged. So this essentially allowed high income investors to defer the capital gains. It was created in 2018. So there were, the max you could do is 8 years of deferral, and that was coming up. And then this opportunity was going to go away. The new law is now allowing states to designate a new round of qualified opportunity zones every 10 years. So it has essentially made this perpetual. The definition of low income becomes slightly more restrictive. I won't go into the specifics of that, but starting in 2027, high income investors could continue to defer capital gains by investing them in these qualified opportunity funds. And again, there are various options for the types of investments within them. So if this is something that you took advantage of back in 2018, or as we're talking about deferring income and potentially avoiding capital gains because we don't want to push ourselves into a different tax threshold, this is a way to potentially not avoid, but defer those capital gains in kind of 10-year increments.
Thank you.
You're welcome.
Let's open it up to any questions that any of the attendees have. And it could be something that maybe we didn't cover, but it's relevant to just tax planning and strategies overall. So Hannah, are there any questions?
Sure. I have a question here. Are there any limited benefits that you recommend we look into quickly?
I would say, off the top of my head, I would think of the charitable contributions just because there's limitations that come into play next year. I think that's one of them. I think, as Claudia mentioned, 529s, depending on your situation and if you want to be able to maximize that $20,000 withdrawal versus the 10,000, you could do that for this year. Other than that, I'm trying to think. Claudia, chime in if you think of anything off the top.
Yeah, I think one of the big things that I take away from reading all of this is There are a lot of moving bits and pieces, but if you find yourself close to that $500,000 MAGI line, you really need to start doing some planning. I think there's a lot of opportunity to save a lot of tax dollars, and do, as Lena said, some of these strategies where we're bundling deductions, where we're bundling charitable contributions. And it really becomes a almost a multi-year tax planning strategy for the next 4 years. So it's becoming a little more complicated. And I think for those that are really close to that line, if you are one of those, you're probably one of the first people that should start looking at some of these strategies.
Yeah, I think, one of the things that I really picked up on in going through this is some of the things that you may want to start doing in, let's say, 2026 may have a negative impact to you in 2027, depending on what's happening in your world. We have quite a few clients who have various bonus payouts or stock option strategies or things that vest, retirement payouts. And so you really have to look ahead. You can't just focus on this year alone. So the reason that we wanted to do this webinar at this time period was because we're in August. So we have until December to really make some changes versus doing the webinar December 1st and then really rushing towards the end of the year. So hopefully this gives a lot of time for you to sit down and talk with your advisors okay, what do I need to adjust? Do I need to adjust any withholdings? Do I need to adjust my contributions into anything? And to start planning for the rest of the year.
Okay, I have another question here. What does the raised limit to $20,000 for the 529 plans mean? Is that contributions or withdrawals?
Yeah, I'll take that one. So yeah, to clarify that is for withdrawals from 529 plans, and that is for the K through 12 specifically. So if it's college education, you are not limited as to how much you're pulling out for anything, but for K through 12 education, that limit on withdrawals has increased from $10,000 to $20,000 per year.
Great. I have another question here. You mentioned above the line. Can you define what that means? What a above the line deduction means?
Sure. So with tax planning, a lot of the deductions or when we talk phase outs and everything, you have to traditionally qualify at certain thresholds, and that means like if your adjusted gross income is at a certain level, then you either can take a deduction or you can't. So above the line means it's a deduction above that adjusted gross income line on your tax return. So any of those deductions above that line means that it's going to reduce your adjusted gross income. And that's a great thing. So above the line deductions are great because it pulls down your adjusted gross income that allows you to qualify for all these various deductions or phase outs, etc. After adjusted gross income, there may be deductions that reduce your taxable income. So that would not be above the line, that would be a below the line deduction. Those are still good and those are still helpful, but an above the line deduction traditionally is more beneficial to you because it allows you access to potentially more deductions. So the more above the line deductions, things that can reduce your adjusted gross income is helpful.
All right, that looks like all the questions we have so far, but if you have any more, we're going to show a QR code at the end where you can schedule some time to talk with Claudia.
All right, great. Thank you, Hannah. Again, thank you everybody who participated in the webinar, who took the time to kind of listen to everything. If you have any questions, as Hannah mentioned, you can scan the QR code and speak to any of the advisors. We have a lot of resources I mentioned in the beginning. And we always say, if you have any other topics that you think would be extremely relevant for us to share and talk about, please bring them up. We recognize this was a very timely one, but we're looking forward to coordinating some more webinars on some good topics. So thank you. And Claudia, we didn't get hit too bad with you know, all the changes and everything, and we're able to keep it, I would say, high level.
That's right.
All right. Thank you, everyone.